Good morning, everyone. How are we doing today? So I wanted to follow on to my video from yesterday. Yesterday, October 3rd, I did a daily financial news show where really the heart of that video was me doing a math calculation to show you how a 500 unit apartment building could lose roughly 50% of its value, and why I think that is going to be kind of the theme of the day of the next market crash. But I wanted to go into that in a little bit more detail because I saw some questions about cap rate. I saw some comments from some members of the millennial and Gen Z generation. So I wanted to do a video specifically about why I believe millennials and Generation Z will be, I guess, the cause, and I don't mean causes in a negative, just a reality that they're going to cause the next real estate crash, or a fall of 30 to 50% of value. And just to be clear, this is not going to be in single family homes. In fact, I believe millennials and Generation Z will help raise the prices in single family homes. But as I shared yesterday, I believe the urban multifamily Class A property is in real trouble. So let's talk about this first. First and foremost, if you were to go back to 2019 or January of 2020 and talk to multifamily investors, they're going to often talk to you about something called a cap rate. Simply said, a cap rate is essentially the return on their capital if they owned the building free and clear. And just the fact is, the lower the cap rate, the less risk they see, the less of a return they expect. And do you know what had the lowest cap rate, historically speaking? It was urban, Class A multifamily. There were some multifamily assets traded at 3.5 or a 4 cap, to use commercial mumbo jumbo. Basically, they were willing to buy a building with a 4% return on their money after, based on their net operating income. Rent minus, call it 50% expenses, take that number, divide by 4%, and boom, that's the purchase price or value of this Class A building. So why would somebody accept a 3.5 or 4% return? Well, they had assumptions, and this is where it gets dangerous. The assumptions, historically speaking, said that millennials and the next generation, Gen Z, they wanted to live downtown. They wanted to be around that busy hustle and bustle area. It was a lifestyle choice. They wanted the amenities of a Class A building, but without the ownership headache. The other thing that was assumed is they were debt burdened from school loans and the like. And lastly, they wanted to be close to work. All of those assumptions, right? Class A building New York, Class A building San Francisco, Class A building Seattle, Chicago, the list goes on and on. Those are all blowing up. Those are all blowing up today. Millennials and Gen Z of age, right? Generation Z goes from, I think it's like 7 or 8 to 24. So we're talking the older of Gen Z, but the trend will continue. This is what they're telling us now, right? Millennials are telling us now very clearly that the hustle and bustle of the city is not there anymore. They're not willing to pay for all of those amenities that are shut down. They're telling us that space is good, and they're making choices all the time. They are now telling us, especially the millennials who are now, some of them in their 30s, that you know what? I can own now. I've paid off my student loans. I have an income that is 50% higher than when I started. They are really having these choices. And then a big change in millennials and in Gen Z, based on some of the comments, they're now making lifestyle choices. And instead of lifestyle choices as we had assumed in these dangerous assumptions, they're saying now, I want to live in the country. I want I want wilderness. I want hiking. I want nature, right? They're saying now that nature is important. They want outside. They don't want to be in the crowds, right? This health crisis is clearly teaching us, simply said, that space is good. Waiting an hour for an elevator, not cool. Not being able to take public transportation in the city because you're concerned, not cool. This work from home, if this sticks, which there are some people say it will and some say it won't, but if work from home sticks even half as much, these Class A apartment buildings that were traded at 3.5 or 4 cap could very easily lose 50% of value. Now, some of you, based on yesterday's video, are like, hey, if you don't sell, it doesn't hurt, right? Well, that's true in residential, right? If your house falls in 50% and you don't sell, you're okay. But what you may not understand is commercial financing has terms 3, 5, 7. Some have bridge loan that forces it. They're value add activities. The debt structure around these Class A buildings in urban areas means that they're very likely going to be reevaluated. And when rents are down, expenses are up, and the cap rate goes from just 4 to 6, the value is gone. Equity is wiped out. Equity call is happening. Can't raise it. Building goes back to the bank. We are about to see in the next 1 to 3 years a significant revaluing of what was once thought to be the safest asset. This is really what I've been searching for. Every crisis teaches you something, and it's always about an assumption that you thought would never be wrong, right? The dot-com trading days, things go up forever. The internet's going to eat the world. Well, lots of companies got evaluated on eyeballs, not profit, and they went out of business. The Great Recession, what happened? Single family homes only go up, they never go down. Let's take out risky debt. Let's take out adjustable rate mortgages because shoot, I'll just refi and it won't be a big deal. Wrong. Well, here's the deal. I don't think the problem is going to be single family for much of the same reasons why I think urban multifamily will be the problem. Because people have to live somewhere. The millennials and Gen Z that were once dominating urban multifamily will go to single family in the suburbs. So I think single family homes will do okay, if not great, in the coming years. But urban multifamily, especially Class A, is in real trouble. We're already seeing in New York City 3 months free rent. San Francisco down 20% and vacancies still rising. Folks, there are going to be some very rich people that aren't very rich anymore. We will have some insurance companies and hedge funds who are the owners of these Class A buildings because, shoot, they were the safest investment. Well, guess what? That assumption is going to prove wrong. I believe millennials and Gen Z are going to leave the urban Class A multifamily for all the reasons we have discussed. Space is good. They can now own versus rent. A millennial who is in their 30s, who is paying $4,000 a month for a apartment in some high rise, it's a good financial decision to own something an hour away. They save money. They have a better quality of life. Plus, all the amenities that make that $4,000 maybe interested aren't there. And again, I think there is this crisis is teaching us, hey, I don't need to be around all these people in this tight space. Let me go out, let me get some nature, let me get close to other things. Let's have experiences. Let's save. Let's stop keeping up with the Joneses. So I really think the next crash, and it will be nasty, it'll be once in a lifetime, is going to be Class A urban multifamily. If you want to see examples, yesterday's video, October 3rd daily financial news, or no, it's called October 3rd financial news. I do the math. I show you how a 500 unit Class A apartment once valued at 99 million could very easily be worth 51 million. That's 50% whack. And oh, by the way, the debt structure is probably at 60. So all the equity's gone. The bank owns it because you're not going to do a capital raise, right? If the value is 50, call it 50 million, and the debt is 60 and your debt structure comes due, you probably have to come up with, well, let's see, if the value is 50, that means they're going to loan probably 32. So you have to come up with 28 million more just to keep the building. That's not going to happen. We are going to see urban Class A multifamily go back to the bank, go to hedge funds. And it's all because the consumer is changing their opinions. The once almighty millennials who will rent forever, want to live downtown, can't buy because it's too expensive. You know what? They're saying, screw you. I'm going to go buy an hour away. Space is good. I'm not going to pay your crazy rent anymore. Downtown is dead. I can work from anywhere. So I really do believe that the millennials and Gen Z are going to cause the next housing or real estate crash, and it's going to be an urban multifamily. Let me know what you think. Leave comments below. I see it coming. How about you? Take care.